the finance bill and the implications of that theme forward. Kamayani Nagar, CEO with Bajaj Wealth, joins us now to understand that what really could be the impact on the institutional inflows into the debt mutual fund, and in next couple of days, now that the finance bill has also allowed grandfathering clause, a lot of HNI and institutional money, will it move back into debt funds? Kamayani, good morning. Thank you for joining us. In your understanding, what could be the real impact on debt mutual funds, especially from HNI investors and from institutional books who, in a sense, historically have always preferred debt schemes over FD because of taxation benefits?
So, very clearly, hi, good morning, Nikunj. Very clearly, the arbitrage now between the taxation goes away. So, actually, it's become a very level playing field now, because now there is no benefit on taxation in the long term on debt mutual funds. So, whether it is fixed deposits in the bank or whether it is debt mutual funds, now it all becomes a level playing field. What is most important is that for us to realize as to what is it that the investor needs, specifically in terms of the HNI investor, what is it that the investor needs or the investor sees in terms of debt mutual fund? Do they only see taxation, or is it also flexibility in terms of returns? Is it also better returns in terms of not only being restricted to the yields on a fixed deposit? It will all depend on, now with the taxation benefit going away, it will all depend on how the investor sees the funds or the returns going forward. In my view, obviously there's going to be a big inflow which will happen between now and 31st March, which is about the next 5 days. We should see some inflows coming in where investors want to lock in funds for the long term, because you do have the grandfathering effect, like you mentioned, and that will give a lot of benefit to institutional as well as an HNI investor in the next 5 days. So we should see some good money flow coming in the next 5 days into the debt fund category. And post that, I think, while I do see some impact, a moderate kind of an impact on the debt funds, I do feel that it will also push more money moving into the equity market and into the deposits in banks, which I believe is the aim to decrease the cost of capital by moving more and more money into deposits, so that we have better lending that happens.
Kamayani, it's been a couple of days since we have heard about this announcement. What's been the initial feedback and discussion with your clients and investors? If there's any, a lot of worry coming around this move as well, and how big taxation really plays a part in the decision-making process? Because your entire thesis of putting money into debt versus equity shouldn't change with just a taxation, revision coming in.
There was initially during the first, because this quite came as a surprise, because there was no, I don't think there was any early white paper that was issued on it. So in the initial couple of days, I think there was a bit of chaos, and there were a lot of customers, a lot of investors asking a lot of questions. I think now people are understanding what the exact impact is. We are going back to all the investors and letting them know what exactly is the impact of the tax arbitrage having gone away. And while it does not decrease the return overall of the debt mutual fund, but I believe taxation, specifically with the indexation benefit, the long-term taxation was very attractive. And with that going away, you are definitely going to see a shadow coming in on the debt mutual funds.
But is there a way to quantify as to what percentage of AUMs could get impacted?
Not exactly as of now. I don't think there is a, this is not the first time that a taxation change has happened. And taxation changes have been happening throughout across the couple of years now. And there have been things that have impacted the market, but I don't think there is any possibility of me giving you any idea of the percentage impact that will happen. But I do feel that it should be about moderate to low. I don't see too much of upheaval happening because of this.
But the indexation changes have happened, like you said, in the past also. I think 3 years ago, this entire indexation benefit was completely taken away. And the same concerns were raised, oh my God, debt mutual fund is dead, money will move into FD. That same argument was given. But there is a very basic difference in FD and debt mutual fund. In FD, when you're locking, the rates, they go up in a very slow and a gradual manner.
Yes.
In debt mutual fund, it's completely different. In debt mutual
Yes.
fund, you get a multiplier advantage. You get a benefit if interest rates come down. So,
Absolutely.
so that's my point. I mean, these are two different asset classes. I know this argument has happened over the weekend that money will move to FDs and money will move to equities, but you understand it much more than that, that we are comparing, in this case, not apple and orange, but we are actually comparing chocolate and pumpkins.
I wouldn't be go that extreme to compare it as to make it as difficult as chocolate and pumpkin. Actually, see the debt category per se has very limited instruments in terms of government securities. It has mutual funds, debt mutual funds. It has fixed deposits. So the category per se is large in terms of what is it that it offers to the investor, and an investor who's a debt category investor will remain a debt category investor. And while we are seeing a lot of people, a lot of investors taking advantages or taking exposures into equity as well, however, the larger risk averse investor, I would say, who still wants to have a better flavor of the market, does want to go in for a debt mutual fund versus a FD. And I agree with you completely. There is a lot of difference between a debt mutual fund and a bank deposit. Bank deposits on premature withdrawals give you a lesser rate of return, whereas debt mutual funds are mostly open ended and they don't impact the rate doesn't come down. Whatever the time period that you invest for, you get that kind of return in any case, right? Plus the liquidity is better in terms of debt mutual funds versus FDs. So I agree with you that the market is definitely different between a debt mutual fund. The investors understanding between a fixed deposit and a debt mutual fund is different, and there could be some migration between debt mutual funds and FDs. However, I clearly feel that we are not looking at a very major impact, which is why I said only moderate to low, if at all, in terms of migration of some amount of debt mutual funds to FDs. I believe the larger impact will be in terms of, or if you see an impact, the impact will be larger seen in terms of the large money, where the indexation or the tax plays a very large role. So the money or super HNI going into debt, I think that is where you will see more of an impact.
Yani, we'll let you go on that note. Thank you so much for joining us today. But let's continue the discussion about the impact of the debt mutual fund taxation revision on the NBFC industry as well, because